In a matter of minutes, 1 lakh crore rupees of market value vanished. It was a massive sell-off that dragged the entire Indian stock market down with it. The trigger for this sudden panic was a single sheet of paper, a resignation letter from HDFC Bank's part-time chairman, Atanu Chakrabarty. In that formal document, Chakrabarty claimed that recent practices within the bank were not in congruence with his personal values and ethics. He offered absolutely no specifics, gave no names, and provided no examples. But the very next day, Chakrabarty walked it back. He went on television and insisted there was no wrongdoing whatsoever, only ideological differences. He suddenly had nothing but respect for the board. This bizarre PR contradiction broke the golden rule of banking: market certainty. Investors didn't know what to believe, turning India's most dependable bank into a volatile liability overnight. And beneath that failure in communication, 2 hidden systemic cracks had already formed. The first crack started forming in 2021. HDFC launched an aggressive wealth management push, targeting high-net-worth non-resident Indians operating out of the Middle East. This diagram shows the product they were pushing. On the left is a standard normal bond. You lend money, you get priority repayment if the company fails, and there is a strict maturity date to get your capital back. On the right is an AT1 bond. It offers a much higher interest rate, but it has no end date, and it carries extreme risk. HDFC executives marketed Credit Suisse AT1 bonds to these investors as safe investments promising up to 13% returns, but they buried the fatal fine print. Under certain emergency conditions, regulators can simply trigger a write-down clause, dropping the bond's value to absolute zero. That emergency arrived in March 2023. Credit Suisse collapsed. As part of a rescue takeover, Swiss regulators triggered those exact clauses, completely erasing $17 billion worth of AT1 bonds. Those NRI investors watched their capital evaporate. While a Swiss court eventually intervened to partially reverse the write-off, the damage was done. HDFC had burned its most valuable clients, exposing a culture willing to compromise fiduciary safety for high yields. The second issue is a strict mathematical crisis, triggered by the historic 2023 merger between HDFC Bank and the lending giant HDFC Limited. To understand the math, look at this ledger system. A bank makes its profit on the net interest margin. It takes in cheap money, like savings accounts that pay out around 3% interest, and expensive money, like fixed deposits that pay out 7%. Historically, HDFC balanced these perfectly to generate a healthy profit margin of about 4.1%. The merger broke that balance. HDFC Bank absorbed a massive 6 lakh crore home loan portfolio from HDFC Limited, but they didn't inherit enough of those cheap deposits to fund it. To cover the shortfall, the bank frantically attracted expensive fixed deposits, physically crushing their overall margin down to 3.35%. And then the regulatory trap snaps shut, enforced by the Reserve Bank of India. Watch how the system changes under these rules. The RBI legally mandates that roughly 21% of a bank's deposits must be locked away in cash reserves and government bonds. HDFC Limited, as a non-bank lending company, never had to follow this rule before they merged. Suddenly, all those inherited home loans are subject to bank regulations. That means 1.3 lakh crores of capital is now trapped and sitting idle. To compensate, the bank's loan-to-deposit ratio spiked to a dangerous 110%. They had lent out significantly more money than they actually held in deposits. The merger was designed to create an unstoppable financial behemoth. Instead, it over-leveraged the institution, physically starving it of the liquidity it needed to grow securely. When you stack these pieces together, the full picture emerges. You have a boardroom fractured over internal ethics, a wealth management division that compromised client safety, and a massive balance sheet mathematically bleeding its margins. Banking functions on a foundation of consumer psychology. Ledgers and macroeconomics provide the structure, but collective belief provides the stability. A mathematical imbalance, like a drop in margins or a cash reserve lockup, can be corrected over time as the bank acquires new deposits, but a profound trust deficit during a period of global geopolitical weakness is an existential threat. HDFC's primary challenge has moved beyond the technical optimization of its loan book. It is now a fight to reclaim its status as India's most dependable institution. If the nation's largest private bank cannot rectify its crisis of trust, it stands as a grim leading indicator for the fragility of the entire financial ecosystem.